Is your mortgage tax deductible? Today, you will learn how to get free refunds from the Canada Revenue Agency, pay off your mortgage sooner, and build an investment portfolio. Do you have the wrong kind of debt? The kind that is not tax deductible, such as credit cards, residential mortgages? Most of us do. The wealthy have debt too. The difference is, they routinely turn their loans into good debt by making the interest tax deductible. So, while the wealthy are transforming their house mortgage loans into tax-free refunds, the rest of us are paying off huge amounts of mortgage interest with after-tax income. Did you know that in order to pay off a $200,000 mortgage loan, you have to earn $700,400? You have to pay $280,000 in income tax. You have $420,400 left over. You'll pay $220,400 in bank interest. All of this to pay a $200,000 mortgage. The solution? The Wealth Advantage strategy is a financial concept designed to help consolidate and convert the non-deductible interest debt of a house mortgage and the credit card balances to the deductible interest debt of an investment loan, which simultaneously ensures the building of an investment portfolio. The tax-deductible mortgage Wealth Advantage plan is designed to achieve 4 goals. Consolidate all bad debts into one tax-deductible debt and one monthly payment. Provide annual tax refunds. Pay off your mortgage sooner. And increase your family's net worth. This is how the plan works. The key is to start with the proper mortgage product that allows the ability to have one portion that represents current debts, bad debt, and a second portion that is designed for the investment, good debt, or HELOC, home equity line of credit. The second portion allows for the funds to be advanced as you need it. This portion will be used for investments and becomes the good debt. The real benefit of this particular mortgage is that as you pay down the fixed or bad debt portion, that amount becomes available in the second portion to be re-borrowed for investments. There is a tax rule in Canada that says that if you borrow money to invest, you can deduct the annual interest paid on the investment loan from your income tax. Let us use the example and assume that the property is worth $350,000. Banks will allow us to finance the property up to 80% of its value. The next step is to obtain a mortgage with the revolving line of credit, HELOC. Depending on our financial needs, the line of credit may start with a limit of $0. In that case, our mortgage will be $280,000. In the case when the mortgage is lower than $280,000, the difference is transferred to the line of credit as available limit. We will use the Wealth Advantage calculator to determine biweekly payments for our mortgage. Continuing our example, the biweekly payments are $750. Each payment is divided into 2 categories, principal and interest. Principal amount reduces our mortgage and the interest amount goes to the bank. Remember, you can only speed up the process of paying down the mortgage by prepaying more of your principal amount. The paid principal amount instantly becomes available as a limit on the line of credit, HELOC. That limit is withdrawn from the line of credit and invested. After 2 weeks, the process repeats itself. The only difference is that instead of investing full principal amount, we leave part of it to cover the line of credit's monthly interest rate obligation. The most advantageous benefit of this strategy is that you receive a free annual tax refund from the government. This happens because each year you claim your annual interest payments from the revolving line of credit on your income tax, and that's how your mortgage becomes a tax-deductible loan. Another advantage of this strategy is that you reduce your amortization and increase your investment portfolio by applying tax refunds against your mortgage and then immediately re-borrow and invest the same amount. The results? After 23 years, our home becomes mortgage-free. The line of credit balance will be $280,000 as a fully tax-deductible interest loan. After 25 years, our investment portfolio will estimate around $586,000. The amortization will be reduced by more than 2.5 years. Total tax savings will be $53,000, assuming a 38% tax bracket. Investment amount net of HELOC will estimate around $305,000 before taxes or $230,000 after taxes. In conclusion, the same mortgage payments and implementation of the Wealth Advantage strategy improves your family net worth by close to $250,000. Procrastination is the enemy of your financial success. Fraser Smith. Please contact Paul Bannock today for no obligation and confidential assessment of your financial situation. You will receive a step-by-step report that will provide a sound financial strategy to help you build a large retirement portfolio, increase a cash flow in your budget, and reduce your overall debt. The choice is yours.